The murky world of private lending has Australia's corporate cop on the case.
The risk has definitely not gone.
These loans have been made and frankly the banks have probably said no to it in the first place.
Locally, there's currently $250 billion worth of private credit loans. But the US is ground zero, and there are fears this massive, near $3 trillion private lending ship is sinking, and investors are jumping out.
Blue Owl's two semi-liquid private credit funds faced elevated redemptions in the second quarter.
Not surprising, with lending rates up as high as 10%. Blue Owl shares have plummeted 36% this year, as investors fret about the lender's exposure to ailing software companies. US auto lender Tricolor Holdings and UK mortgage lender Market Financial Solutions have already collapsed.
People on Wall Street have been wondering, is this isolated, or does this tell us something about the wider economy?
Yeah, there are some signs of strains in the market, but we are seeing some increase in requests, quite a big increase in requests for outflows to take liquidity out.
Private credit is any lending outside the banking sector, like cash loans for riskier investments. Software companies fit the bill earlier this decade. But the smart money's now moving to AI, leaving some investments exposed to software in distress.
There are already many of them going to a payment in kind interest where they just add on debt instead of actually paying cash. But we're going to see more and more pain.
Managing partner of Verdad Advisors, Dan Rasmussen, warns of a negative feedback loop where software companies default and lead to further panic in private credit markets.
Now what's happening is that there's, 100 billion of loans outstanding and there's only 50 billion of new fundraising in private credit. Well, that's going to force defaults on itself because there is no one else who's willing to lend to these companies. No bank is going to lend to them. So either the private credit lends to them or they go bankrupt.
Australia's corporate cop is bracing for the risk of another global credit crunch.
Private credit is now at a size and at a breadth that hasn't been seen before and certainly hasn't been tested in a downturn. So there would be bumps.
Running at $250 billion, it's up from roughly $35 billion just a decade ago.
It's not just been the retail investors in the market, the institutional investors, superannuation funds and others have piled into this asset class.
And it's Australia's $4.5 trillion superannuation sector that's got the regulator worried.
So increasingly, every working Australian, investing Australian, does have exposure to private credit.
I think the Australian market will face its own challenges in the future, just given the amount of capital that's being deployed into this market, into assets that I don't think are as safe as some people perceive them to be.
With lending rates upwards of 15% for these types of loans, ASIC is fearful a property crash could sideswipe the local private credit sector. It's told the ABC millions of superannuation accounts could be taken down with it.
What could go wrong? Investors could lose money, investors could not understand they're going to lose money, and that could happen at some scale.
Lending against property construction transactions is a good way to make money if you know what you're doing and you can actually step in should the borrower default. But it is a very good way to lose money if you don't have that ability to step in and complete a project, as an example.
It's a growing private credit problem that could have a very public fallout.